you make of these latest developments?
Well, clearly, Martin, it's a grave situation, and it's a demonstration of the significant increase in geopolitical risk. I'm not at all belittling that, but in terms of my domain and how we think about things and equity markets, the obvious observation here is that we've seen in recent weeks, with the rally in equity markets, a relaxation of risk concerns. Mm-hmm. We had a tremendous amount of risk, of course, associated with tariffs priced into the early April lows. Since then, markets up until yesterday's close had rallied over 20%, 22%. That's globally, but Asia Pacific as well.
But the risk there was of recession, not war.
Oh, for sure. Yeah. So what I'm saying is that you've seen a moderation in some risk indicators, particularly trade-related risk, or more broadly economic policy uncertainty, and also a significant easing in financial conditions. If you look at our U.S. Financial Conditions Index, which spiked to alarming levels and resulted in us having a short-lived recession forecast, that's now back down as of last night to levels that were lower than they pertained in early April. Geopolitical risk had also moderated somewhat, but obviously is spiking now. We've seen that most recently embodied in oil prices, which are up 8%. So I think we're reminded again of the uncertain environment that we're living in. This is a new shock to markets, but from a purely market perspective, the fact that we've rallied a lot, valuations have recovered, and that various levels of volatility and other measures of concern have moderated, it shows that they're vulnerable to some sort of a correction, which obviously is what is taking place in terms of futures markets.
Tim, and we've been here before, right, with oil and with Iran, right? I think the biggest risk right now immediately is, because we're talking about Iran, Strait of Hormuz, supply constraints, and oil going even higher?
It could do, for sure. Our oil analysts, our commodity analysts have not issued a formal statement on this so far, but it seems pretty clear that there is less clear and somewhat unbounded upside risk from a re-expansion of geopolitical risk premium. We've seen this before. I don't want to put numbers on this, but I mean, certainly oil in past times of concerns like this has spiked significantly, and I think it's fair to say that the price will be dictated less by the near-term demand-supply fundamentals, but more by the expansion or compression of the geopolitical risk premium associated with that.
Sherry, come in on this.
Yeah, and Tim, so would it change your calls on some of the Asian economies or markets that could have benefited from lower oil prices? Because that has been really the premise that the market has been working on until this morning.
That's a very good question, Sherry. Obviously, India is a significant importer of oil. Most of Asia is actually an importer of oil, with the exception of Malaysia and Indonesia. So, in terms of broader commodity exposure. So, obviously, when you get a spike like this, it's negative. I think we should be clearly aware that we need to be careful about how far we extrapolate this. I mean, it's still uncertain exactly how things will play out. We don't know how long this particular spike will last. The current concerns, which are obviously significant, as I said before, I don't want to belittle them. The underlying demand-supply balance, the fundamental balances that we were looking at before these recent events, were arguing for softer oil prices. So I think we need to balance the kind of the longer-term fundamentals against this shorter-term spike in uncertainty and concern.
And with the geopolitical risks, I don't want to say coming back because they've been there, but not really priced in or highlighted more. And then the dollar is coming back a little, now above a 98 handle. So a little bit of a comeback for the U.S. dollar on a day when we were actually starting the show talking about a de-dollarization trend. Sure, we need to watch this developing story, how it unfolds, but could this be really the turnaround story, at least in the near term, as the market focus could likely be back on the Middle East tensions?
So, again, I think we need to understand how asset prices move in the context of where they are and what the incremental news flow is. In the case of the dollar, as you just correctly said, on the DXY index, the broader DM trade-weighted index, the peak was in mid-January at roughly 110, and we got down to 98 at their lows. That's a 10-11% decline. And it's going from a position at the beginning of the year where the dollar was widely expected to go stronger. Consensus has shifted to a dollar negative story, and that includes us. What my point here is that against that price action and against that shift in mood, there certainly has been some a risk of what you might call an upside correction, even if the overall trend, which we believe fundamentally is toward dollar weakness. I think the setup here is one where we could see an upward correction in the dollar, and current events would certainly be a catalyst for that. So I think we could see some strengthening in the dollar. I'm not a currency strategy is not my
Sure.
domain, but I think it's reasonable as a broad analyst of prices to see an upward correction in the dollar given these events.
Yeah, and given these events, and we will have to see what kind of a repercussion it will have on the broader region, of course. But I'm thinking about sectors like utilities, energy, and defense to go even higher on the back of this. And some investors have been really holding on to these themes of, especially around the defense, given what's going on in, of course, the other geopolitical tensions, of course. Would you agree with that, or would you change your calls on some of the sectorial breakdown as you get off the air today?
So, Sherry, you're really singing our song, I've got to say. We've been positive in defense for over 2 years before it was in the limelight. It's been one of the continuing themes that we've been articulating, and we note that there's actually a positive correlation in terms of the relative performance of defense stocks with the global geopolitical risk index. So when you get a spike in geopolitical risk, you tend to see defense stocks do better. I mean, it makes total sense, but it's also very much there in the data. The larger picture, which we've got in many of our reports, and it's a theme which we continue to really advocate, not just in Asia, but also globally. And we note that Europe defense stocks have obviously led the charge this year, even though Asian defense stocks are up in the mid-20s percentage year to date. The key driver is that if you look at 40-year history of global defense spending, it's pretty much up and to the right. If you express that same data in terms of percentage of global GDP, we've been hovering around 2.6 or less than 3%, and clearly with efforts to increase defense spending in Europe, tensions that are still prevalent and are resulting in spending in Asia, and the U.S. leaning into its defense budget, where it's now spending over $1 trillion a year. It certainly seems that the overall theme of defense spending is increasing, and on top of that, you need to not only replace existing material, but also account for the changes in the modern battlefield, which Ukraine and its AI and drone-led attacks on Russian forces has clearly demonstrated there's a shift in the modern battlefield. Yeah. All that is basically driving what we think is a long-term secular rise in defense spending. So we're very positive on this story. Sad to say, but from a pure investment perspective, that's our view.
Yeah, what you're talking about, Tim, is of course the new gen weaponry, newer, lighter, smarter, cheaper as well, and increasingly autonomous.